How can married filing separately reduce student loan payments? Imagine you're trying to lower your monthly student loan bills, but you're not sure how your tax choices can help. Well, one option you might consider is filing your taxes as married filing separately. This decision can have a big impact on how much you pay each month on your federal student loans. When you file your taxes, you pick a filing status. The two main options for married couples are married filing jointly or married filing separately. If you file jointly, the government looks at both your incomes combined when calculating your student loan payments. But if you file separately, each spouse's income is looked at alone. This means your student loan payment is based only on your income, not your spouse's. This can be especially helpful if one spouse has a lot of student loans and a lower income, while the other has a higher income or no loans at all. For example, if you are the person with student loans and a moderate income, but your spouse makes a lot more money and has no loans, filing separately could lower your monthly payment. That's because your payment is based only on your income, not the combined household income. Filing separately is most useful when there is a big income difference between spouses or only one person has federal student loans. It can save you money on your monthly payments, but it also has some trade-offs. For instance, you might lose some tax benefits. You cannot claim the student loan interest deduction if you file separately. You might also miss out on credits like the Earned Income Tax Credit or education credits, which could increase your tax bill. To see if this makes sense for your family, you should compare both options. Calculate your student loan payments and your taxes for both filing statuses. Sometimes, the savings on student loans outweigh the extra taxes you might owe. Other times, especially if both spouses have similar incomes or loans, filing jointly might be better. For Asian American families managing both student loans and family finances, these steps can help. Review both spouses' incomes and loan balances. Use tools like the Department of Education's Loan Simulator or consult a tax professional. Estimate your taxes with both filing options, considering the credits you might lose. Then, compare the total costs of each choice. Remember, if you later find out that filing jointly would have been better, you can usually amend your tax return to switch from separate to joint. But you cannot do the reverse. If both spouses have federal student loans and file jointly, the repayment plans often split the total debt based on each person's share. This can sometimes make joint filing more attractive, especially if incomes are similar. In many Asian American families, cultural expectations around shared finances are common. But it's important to understand how the tax and loan systems treat married couples. Weigh the financial benefits of filing separately against your personal or cultural preferences. Talking openly and understanding your numbers will help you make the best choice. Choosing whether to file jointly or separately is a personal decision. It depends on your specific situation. For some, filing separately can lead to lower student loan payments. For others, the tax benefits of filing jointly might be more valuable. Taking the time to compare both options and consulting a tax professional can help you find the best path for your family.